Hi, Terry. So today we're going to be talking about commercial loan rates and how to get the lowest rates. As the president of the apartment loan store, you financed over $4 billion of commercial loans over the past 24 years. I've been shopping for a loan and rates vary, I know, from lender to lender a lot. So how do lenders determine their interest rates, and how can we bargain with them, and which ones should I go to for the lowest rate?
Okay, well, let me start out. But this is going to be kind of hard to believe, but lenders, commercial lenders sell money in the same way that car dealers sell cars. You'll notice that when you ask a car dealer to lower the price or if you even walk away, they're going to tell you something like, oh, but this is just $500 over invoice. I got to make something. Well, if you start walking away from a lender, just telling them that the price is a bit higher than you had in mind, they're going to say, well, based on our cost of funds, I'm giving you our best rate. So what they're pretty much doing is setting something in stone and telling you that this is the price.
But
And
that's not true.
well, it's just that, okay, well, let's take a look at car dealers. Car dealers actually start out with the cost of the vehicle that it costs them. Okay. They then have to pay for their rent, their utility bill, and if they own the building, their taxes and insurance and da 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 da, and their employees. Okay. Well, the same thing goes for the lender. The lender starts out with their cost of goods, and which is really their cost of funds. And then on top of that, they've got to add on the cost of their taxes, their insurance, their rent, and uh, and so on. And then on top of that, they have to take a look at what does it cost them to put a loan on the books. They add that on. And then that's their break even point, but they've got to make a profit. So they then decide, well, how much do we want to make? Just like the car dealer.
So, Terry, how do you get lenders to give you a better rate?
Okay, well, there's only one way. And a lot of people do this naturally anyway, but you've got to get them to compete. And in a moment, I'm going to go through that.
Hello, and welcome to the Encyclopedia of Commercial Real Estate Advice channel, where we give insider tips on over 500 real estate topics from the book, The Encyclopedia of Commercial Real Estate Advice by Terry Painter. All right, Terry, I'm curious. So tell me more. How do these commercial loan rates get set, and how do I bargain with lenders?
Okay, well, let's take a look at your first question, and that's how do the rates get set? Just about every commercial loan, and for that matter, residential loans as well, the rates are set by an index and a margin. So what you have is you have the index is something that really is set in stone. Like we have U.S. Treasury yields, we have the federal home loan rate, we have prime rate, and we have LIBOR rate. Those are the main four. Those are indexes. And on top of that, the lender adds a margin. Okay, so the question is, is what, so, so if you have a rate, let's just say, let me just point this out. If you have a rate where the margin, it's a treasury yield, let's just say this is a 10-year fixed Fannie Mae loan, so they're going to use a 10-year treasury yield. And let's just say today that's at 2.25. And then the lender decides they're going to add a margin of 2.25 to that. And in that margin, by the way, contains their profit. So anyway, so 2.25 and 2.25 is 4.5%. So that's the rate they're going to quote you.
So, but if they are tied to an index, plus they have to make their margin, and this is what sets the rates, then how do you get them to lower the rate?
Well, that's just it. It's really a system of smoke and mirrors. Lenders would love for everybody to believe that this is set by some government regulated system. Okay, as I mentioned, the index is, in a sense, regulated and set up that way. And it does really reflect what current rates are doing today. But the margin, what you have to understand is the lender could make the margin whatever they want. So the margin is where you can bargain with them. And it's just that you have to understand that if you were to, for a bank, let's say, if you were to ask them to lower the rate by half a point, that's like a lot to them because just it's just, because they make all their money from interest over many years. And so let's just say this is $1 million loan, and you could perhaps get them to lower it a quarter of a point, because even that could be, uh, you know, over $25,000 in earnings for the bank over, you know, 5 years that they're,
Right. So
because
we
it's
need to
compounding.
know sort of the range. When I'm negotiating, how low, what's a reasonable expectation to
Yeah.
negotiate?
Well, let's just say that the rate is 4.5, and this is a 5-year fixed rate at a bank. And if you're going to ask them to lower it by half a point, or let's just say even a full point, you think, well, I could get them to lower it down to 3.5%. Why not? Why they can do that? Well, the problem is that they really cannot, because it's just that that would be taking most of their profit away. Reasonable amount would be probably trying to get a lender to lower the rate by a quarter of a point. And that's still a fair amount, but to the lender over that 5 years, they're probably going to be giving up over $20,000 in income. So,
Okay.
but yeah,
So a quarter of a point, a quarter. So which
yeah.
commercial loan programs already have the lowest rates?
Okay, well, that's a good question. What I want to do right now is just point our viewers to the URL below. That's my article and webpage on, it's like over 12 pages. It has the major top 15 commercial loan programs in America. It has today's interest rates, and also you could just go through, and there's like over 20 loan terms, qualifiers. Do you want to find out how much you have to put down? That's in there. So just go through these loan programs and decide which ones you're the most interested in. It will really point you in the right direction. But
Okay.
also, before choosing a loan program, you're going to need to know, like what the purpose of this loan is. If it's a permanent loan, then you're going to want a long-term fixed rates, and so you're going to want to go with, if it's multifamily, with Fannie Mae, Freddie Mac, uh, commercial mortgage-backed security loans. Life companies have really long-term fixed rates as well. If you want to just do a fix and flip of the property, then you could go to a private debt fund lender, or even your community bank, which could do like a light rehab loan for you. So, and all these programs, if you go to that article, it actually will tell you. I don't have time to do that in this video, but it will
Okay.
tell you, like, uh, just the parameters of these different commercial loan programs and their rates today.
Okay, great. Thank you, Terry.
Okay, so we're talking about how to get the lowest rate right now. And what you have to understand is that all loan programs, commercial loan programs, are not created equal. Uh, Banks have to borrow money on the short term for the most part, or they don't really feel safe about the future. So they don't really feel comfortable setting the rate on really long term. Well, the larger banks can do that, like Wells Fargo, Chase, Citibank, Bank of America, and so on. But the small community banks pretty much have their hands tied as to how, they really can't safely lend for about 5 years. So you have to understand, you have to first of all pick a loan program based on what it can do for you and whether it's going to get the job done for you. If it's a permanent loan, then it's you're going to need to uh, find a loan that's going to fit the term that you plan to hold the property. If you're going to keep the property for retirement, let's say, then you're going to want to go with a long-term fixed rate. Well, small banks don't necessarily do that, but large banks do. Credit unions, might feel comfortable lending you money for 7 years. Some will go to 10 years, but the very lowest rates are going to come from on multifamily from Fannie Mae, Freddie Mac, life companies, or
Okay.
or actually HUD FHA has the very lowest rate today with a 35-year fixed rate, amortized for 35 years. So it doesn't get much better than that.
Right.
So you have to, so again, take a look at that URL and go through the loan programs and find the program that is best for you. Okay, so now let's get into how do we get lenders to compete? Because that's how you're going to get the lowest rate. Okay, how do I know this? Well, it's just that, okay, so at the apartment loan store, we get shopped to death. It's very competitive out there, especially when you're selling mortgages on the internet like we are. And what we require, if somebody's going to shop our rates, is for them to actually show us that they've already gotten a better rate from another lender. So that's step number one. Get get a rate that is the best you can with the terms that are the best you can, and then take that to another lender. I mean, this is basic nuts and bolts. It's
The
obvious, but
shopping
still,
101, right?
probably 101, yeah. But you got to bet a lender, if they see it in writing, they see a letter of interest from another lender, their adrenaline gets going and they think, I got to beat this. Keep in mind that most lenders, especially banks today, they have more money to lend than they have borrowers. So they're not making anything on that money that's just sitting in their bank. So you want to incentivize them to bring that rate down. So if they see a better rate, okay, so now you've gotten the rate lowered. Well, take a look at the other loan expenses. What about the cost of the appraisal? Maybe you could get the lender to pay for that. Take a look at the loan fee. Well, in the lending world, the loan fee and rate kind of like go together, because either way you look at it, that money is going to be coming out of the lender's pocket and into your pocket if you get them to lower either the loan or the loan rate. So those are really key. And for securitized loans like commercial backed security mortgages, Fannie Mae, Freddie Mac, HUD, FHA, and so on, it's sometimes easier to get those lenders to lower the point that they're charging you, because they can also put that into rate and balance it out a bit. It doesn't cost them that much to do that. But for a bank to actually lower that rate, like I mentioned, and it's good for the next 5 years, they're going to be getting, let's say, $1,700 less a month because they've lowered that rate. They're not going to want to do that. So sometimes it's easier to get a lender to lower the loan expenses, including the loan fee.
Okay, that's so helpful to understand. Thank you.
Yeah. So the last thing to remember is that going back to the lender's break-even point. Okay, so the lenders know what that is, and they also know their minimum amount of profit to make it worth it. A bank president is accountable to the shareholders, and the way they keep their job is by giving good returns on the investment to their shareholders. That means they have to run these loans profitably. So there's a point where every lender is going to say, no, I can't lower the rate that much, or I can't throw in the loan fee or something. So it's really difficult. You're not going to find out what a lender's floor rate is. All lenders have that. That's the lowest they can go. But so the only way you can find that out is by pushing them to compete. And then you'll see, they'll get to a point where they'll just walk away. And you've gotten it down as low as possible.
It sounds like developing those relationships with the lenders that you're working with is really important to be able to negotiate these things and have somebody really work for you and work on your behalf.
Actually, I'm really sorry to disagree with you, since I'm, in the lending world. I would say almost exactly the opposite is the case. When people have a relationship, it's not to say your lender is not necessarily going to give you a better deal because they have a relationship with you and they like you. They're watching out for number one, which is them and their lending institution. So unfortunately, if your buddy at the bank or your favorite mortgage broker might not necessarily, you're going to have to force them to compete to get a better rate. And that might be unpleasant if that lender is your friend. It's not to say you can't keep things friendly. It's just that lenders are used to being shopped. So, they have to get used to it if they're not. This is just part of what it is. We do it all the time, and we have so much in our arsenal to get rates down for our borrowers. And then if we hit our volume levels that we need, we could give them much better deals. The same is true for any lender.
Okay, well, that's so helpful.
Okay, I just want to conclude by just asking our viewers to please subscribe and hit the like button if they're enjoying this video and want to see more. And also leave a comment. I'd be pleased to answer it, or I'd like to hear what you thought of this video. Okay, we'll see you in the next video. Thanks.
Thanks, Carrie.